Most people think Bitcoin moves because of hype, influencers, or retail traders chasing green candles on their screens. But if you look closely at the data from the past 18 months, a different story begins to emerge. A quieter story, a slower one, and potentially a far more important one. Because while headlines focus on daily price swings, something much bigger has been happening in the background. Large institutions, fund managers, pension funds, and financial firms that move billions at a time have been steadily increasing their exposure to Bitcoin. Not loudly, not dramatically, quietly. And historically, when large capital moves quietly, it usually means one thing: the real move hasn't started yet. Let's start with a simple question. Who actually moves markets? Retail investors feel powerful when prices rise or fall quickly, but the truth is that individual traders rarely sustain long-term trends. Real trends are created by large pools of capital: insurance companies, sovereign funds, asset managers, pension funds managing retirement money for millions of people. These institutions don't chase hype. They move slowly, carefully, and most importantly, they accumulate over time, often before the public realizes what's happening. If you look at Bitcoin exchange balances, a very interesting pattern appears. Over the last few years, the amount of Bitcoin held on exchanges has been steadily declining. That means coins are being withdrawn into long-term storage rather than left available for quick trading. That's not the behavior of short-term speculators. That's the behavior of long-term holders. Now ask yourself, who has the patience and capital to think in years instead of days? Institutions do. Another signal comes from the rise of spot Bitcoin ETFs. For years, large investors hesitated to enter crypto markets because of regulatory concerns, custody risks, and operational complexity. But ETFs changed that. Suddenly, exposure to Bitcoin became as simple as buying a stock. And when barriers disappear, capital flows. What makes this particularly interesting is the type of capital entering the market. Retirement funds and wealth managers typically move slowly. They test allocations, 1%, 0.5%, sometimes even less. But when trillions of dollars are being managed, even a small percentage represents enormous buying pressure. Think about that for a moment. A 1% allocation from a major pension fund could equal billions of dollars entering the market, not in a single day, but gradually, methodically, week after week. And gradual accumulation is almost invisible unless you know where to look. Another piece of the puzzle lies in volatility. Historically, Bitcoin was known for violent price swings, massive spikes followed by brutal crashes. But recently, periods of relatively low volatility have become more common compared to earlier cycles. Low volatility during accumulation phases is a pattern seen in many markets. Large buyers prefer stability. They accumulate without driving the price up too quickly, because sharp moves attract attention and increase costs. Quiet markets often precede powerful trends. There's also a psychological factor most people underestimate. Institutions don't think like retail traders. They don't ask, will Bitcoin double next month? They ask different questions. Will this asset preserve purchasing power over the next decade? Will it provide diversification against monetary risk? Will it behave differently from stocks and bonds during crises? Those are long-term questions, and long-term questions lead to long-term positioning. Now consider the macroeconomic environment. Government debt levels continue to rise. Interest payments alone have become a significant budget item in many countries. Central banks face a difficult balancing act between controlling inflation and supporting economic growth. In uncertain environments, capital searches for alternatives. Historically, gold played that role. But for a younger generation of investors, and increasingly for institutions, Bitcoin is beginning to be viewed as a digital store of value. Not a replacement for gold, but a complement to it. And here's where the story becomes even more interesting. Bitcoin's supply is fixed. That's not marketing language. It's a mathematical reality built into the protocol. Only 21 million coins will ever exist, and a significant portion of those are believed to be permanently lost. That means the available supply is smaller than most people realize. When demand increases for an asset with limited supply, the price doesn't need to explode immediately. It can rise slowly at first, then accelerate as scarcity becomes visible to the broader market. We've seen this pattern before, not just in crypto, but in commodities, real estate, and even equities. Early accumulation, public awareness, rapid expansion. Another data point worth examining is long-term holder behavior. Metrics tracking coins that haven't moved for extended periods show a growing percentage of Bitcoin being held without selling. That suggests conviction among holders who are not reacting to short-term fluctuations. And when supply becomes increasingly locked up, the market becomes more sensitive to new demand. It's like a spring being compressed slowly over time. Then there's the global perspective. Bitcoin is no longer just an American or European phenomenon. Adoption has been growing in regions facing currency instability, capital controls, or high inflation. In those environments, Bitcoin isn't viewed as a speculative asset. It's seen as a financial lifeline. That global demand adds another layer of support that didn't exist in earlier cycles. But perhaps the most overlooked factor is generational change. Over the next decade, trillions of dollars are expected to transfer from older generations to younger ones. And younger investors, on average, are more comfortable with digital assets. They grew up in a world where value exists on screens. Bank balances, stocks, digital goods, online businesses. To them, Bitcoin doesn't feel abstract. It feels natural. As wealth transfers, investment preferences often transfer with it. Now imagine that shift happening while institutional adoption continues and supply remains constrained. You begin to see why some analysts believe the long-term trajectory of Bitcoin could be very different from its past cycles. But there's another layer to this story that most people miss entirely. Market narratives often lag reality. By the time headlines declare that institutions are buying, much of the accumulation has already occurred. Large investors don't announce their strategies in advance. They execute quietly, then disclose later through filings and reports. By the time the public connects the dots, the price may already be far higher than where accumulation began. This doesn't mean prices only go up. Markets never move in straight lines. Corrections happen, volatility returns, fear cycles repeat. But long-term trends are shaped by capital flows, not headlines, and capital flows are increasingly pointing in one direction. Another aspect worth considering is infrastructure. 5 years ago, institutional custody solutions were limited. Today, major financial institutions offer secure custody, compliance frameworks, and integrated trading platforms designed specifically for large investors. Infrastructure often precedes adoption. Highways are built before traffic increases. Financial infrastructure works the same way. When systems are in place, capital moves more easily. There's also the geopolitical dimension. In a world where financial sanctions and currency fluctuations play an increasing role in international relations, neutral digital assets have strategic appeal. Bitcoin operates without central control, which gives it a unique position in the global financial landscape. Whether governments embrace or resist that reality, the underlying technology continues to function, and markets adapt to realities, not opinions. Let's step back for a moment and look at the broader picture. You have declining exchange balances, growing institutional access, long-term holders increasing, global adoption expanding, and a fixed supply. Individually, each of these factors might not seem dramatic, but together, they form a pattern. And patterns are what analysts watch most closely, because patterns reveal trends before headlines do. Now here's the question that matters most. Not whether Bitcoin will rise tomorrow or next week, but whether the structural forces supporting it are strengthening or weakening. Right now, many of those forces appear to be strengthening. That doesn't guarantee outcomes. Nothing in markets is guaranteed, but it does shift probabilities. And in finance, probabilities are everything. There's a saying among professional investors: the big money isn't made in the buying or the selling, it's made in the waiting. Accumulation phases are often boring. Prices move sideways, media attention fades, retail interest drops. But beneath the surface, positions are being built. Then, when momentum finally returns, it feels sudden to the public. even though the groundwork was laid long before. We've seen that story play out many times across many markets, and it may be playing out again now. So the next time you hear someone say Bitcoin is quiet or that nothing interesting is happening, remember this. The most important moves in financial history often begin in silence, not with headlines, not with excitement, but with quiet accumulation, steady conviction, and capital moving where few people are looking. And by the time everyone starts talking about it, the opportunity that seemed invisible suddenly becomes obvious. That's how markets work. And that's why the data nobody talks about sometimes matters the most.